SA 320 Materiality in planning and performing an audit. Benchmarking. It is a method of computing materiality. Materiality level equals to benchmark base into percentage. Step 1. Decide benchmark. Factors affecting identification of benchmark. Attention of user of financial statements on items of financial statements. Ownership structure and financial structure. Relative volatility of benchmark. Elements of financial statements. Nature of entity, economic environment, industry, life cycle. For example, for pharma companies, focus is on R&D. FMCG companies, focus is on advertisement. In case of boom market, focus is on profit. In case of decline market, focus is on cash flows, that is survival. Examples of benchmarks categories: income related, total revenue, gross profit, profit before tax for continuing operations, often used by profit-oriented entities. If volatile, use other use others like total revenue or gross profit, total expenses, total equity, net asset value. Next, step 2, normalization. Financial data for benchmarking comes from prior period financial statements and positions, budgets, forecast of current period, adjusted for change in economic environment, change in industry, change in circumstances. Further changes for exceptional items, time period can be less or more than 12 months. Step 3, determine percentage. Benchmark is inversely proportional to percentage. Excess professional judgment in determining the percentage. Example, PBT from continuing operations 5%, low base high percentage. Total revenue 1%, high base low percentage. So if the percentage is high, benchmark will be low. If the percentage is low, benchmark will be high. Inversely related. Next, material materiality at a financial statement level and transactions balances disclosure level. First, determine materiality for financial statements as a whole. Generally, same materiality is applied for transactions, balances, disclosures. In specific circumstances, lower amount of materiality for transactions, balances, disclosures will be considered. Factors which indicate a separate level of transactions, balances, disclosure materiality. Law, regulation, financial statement requirements, affects user expectations of measurement or disclosure. Key disclosures in relation to industry. Attention is focused on particular aspects of the business. Views of those charged with the governance or management will be useful in determining transaction balances disclosure level materiality. Performance materiality. Audit is not foolproof. There will be always some undetected misstatements. Some part of materiality level should be allocated to undetected misstatements. Audit team will detect some part of materiality level and allocate it for undetected misstatements. That is called haircut. That is called haircut. Remaining materiality level after deduction is of a lower amount, and this is called performance materiality. This performance materiality is used for risk assessment, deciding nature, timing, extent of audit procedure, evaluating uncorrected misstatements. Audit team will check whether uncorrected misstatements are within performance materiality. This will ensure total misstatement equals to uncorrected plus undetected are within total materiality. Audit team will be able to conclude whether financial statements are free from material misstatements. Next, for example, 10 crores is the total materiality level. 3 crores, that is 30%, is the haircut for undetected misstatements. 7 crores, 70% is the performance materiality for uncorrected misstatements. Suppose at financial statement level materiality 10 crores, that is 10 crores into 70%, 7 crores. It is the financial statement level performance materiality. What is transaction balances disclosures level materiality? If it is 6 crores, then 6 crores into 70%, that is 4.2 crores. This is transactions balances disclosure level performance materiality. Next, the relationship between tolerable misstatements and performance materiality. Tolerable level of misstatements is generally same as performance materiality. But if we are doing sampling for part of the item, example only credit sales of last quarter, which contributes say 40%, tolerable level equals to 40% of performance materiality. Revision of materiality. During audit, if auditor gets new information that would cause him to determine different materiality, auditor shall revise materiality. If auditor concludes lower materiality level, auditor shall determine need to revise performance materiality and nature, timing, extent of further audit procedures. Examples when revision may be required. New information is there, our decision to dispose major part of the business is there. Change in auditor's understanding or as a result of a further audit procedure. Next, during year, actual financial result substantially different from anticipated. In such a case, materiality need to be revised. Materiality need to be revised. Next, documentation. What are the things that need to be documented? Financial statement level materiality need to be documented. Transaction balances disclosures level materiality need to be documented. Performance materiality need to be documented. Any revision in above during the year need to be documented.